A very important question that gets asked is, how is a valuation determined? Well, the answer comes down to two very important factors. What's the free cash flow of the business, and what multiple of that cash flow is a buyer willing to pay for the business? Let's talk about free cash flow first, and then let's talk about the multiple range that a buyer would be willing to pay. First, free cash flow. Forget about your tax returns, because we all run our businesses the same way. We get our businesses to pay for as much of our personal expenses as we can to help us from a cash flow standpoint and to help us from a tax standpoint. But when it comes time to valuing your business, you want to do the opposite. You want to show a potential buyer what the actual free cash flow of the business is or could be if all of the owner's compensation, if all the owner's personal expenses, if all the non-reoccurring charges, if all of that was added back into the cash flow. So it's the actual free cash flow with the owner's compensation and all their personal expenses and all the other non-reoccurring charges being added back. So the first thing we have to do is determine what that free cash flow is. The way we do that is we get the last 3-year profit and loss statements. We take a look at the profit and loss statements. We try to identify all the expense items that are either owner compensation related, owner personal expense related, owner benefit related, they're non-reoccurring charges, and we try to add those back to the actual expense items to come up with the actual free cash flow itself. And so once we've determined what the free cash flow of the business is on a trailing 12 months basis, then from there we need to figure out what multiple that a potential buyer would be willing to pay for the business. In the industries that we work in, the size of the multiple range, it first depends upon the size of the cash flow. So, and multiples tend to trade in bands. So if the cash flow is around $500,000, the multiple might be between 2 and 4 times that cash flow. If it's $1 million, the multiple might be between 3 and 5 times. If it's $2.5 million, the multiple might be between 4 and 6 times. If the multiple is $5 million, the multiple might be between 5 and 10 times. And so the first thing we have to do is determine the size of the cash flow, and then from there we plug in what the multiple range is, and then once we determine what the multiple range is, we need to figure out where within that range your business is going to fall. Now, determining where you're going to fall within that range, there's a whole list of subjective factors that are going to play into that. It's what the revenue mix is, it's how steady the revenue's been growing, it's what your lead generation process that you have in place. It's what digital marketing strategy do you have in place? How much new construction do you have? What percent do you have of service and maintenance contracts? How large is your management team? How large is your tech team? And finally, how dependent is the business on you? So when we look at all these 8 or 10 different subcategories, will help determine specifically where within the multiple range your business will fall. And then when we multiply the multiple with the cash flow, that gives us a rough idea as to what the business is worth.